Thank you for sparing your time this afternoon to be with us in the media briefing on the results of the company for the second quarter ended 30th September. Two disclaimers before we proceed further with the presentation. One is towards the forward-looking statements that could be made in the course of our conversation. And second is you are sitting in the premises of a company which essentially works on project business, and that too infrastructure project business. And our business does not lend itself to 90-day evaluation of progress as the markets would like. So the numbers that you're going to see on a quarterly updates are not going to be representative of the position at the end of the year. And one quarter is too small a time for us to really turn around a project business and much more the infrastructure business. Having said that, let's look at how we have performed between 1st of July 2015 and 30th September. Revenues have gone up by 11% for quarter two, and for the half year it's moved up by 9%. EBITDA margins for the quarter two has moved up by 5 basis points, and for the half year it's down by 88 basis points. This reflects the income that we had from a substantive transaction last year when we divested Dhamra Port, and the profits are embedded in the margins that you see. The profit after tax for the quarter two is up by 16%, and for the same reason of the one-off Dhamra sale, they are down by 12% at the half-year level. Order inflows have been down by 28% for the quarter two and down by 25% for the half-year, reflective of the investment momentum in the economy that we see today. The order book, however, has moved up by 14% both for the quarter two as well as for the half year. To start with, let's look at how the orders have panned out for the company for the quarter. The company has won 286 billion rupees worth of orders in quarter two, which together with the 264 billion rupees worth of orders that it has won on quarter one makes it a total of 550 billion for the half year, April 1st to 30th September. This is down by 25% as compared to 732 billion of the corresponding period previous year. The couple of things to bear in mind when we reflect on the way the order inflows are shaping. One is in the previous year there have been both domestically and internationally certain large chunky orders which helped us to clock larger order flow than what we normally do in the first two quarters of the year. You will recall that we are often H2 oriented in terms of orders, and that's the way the project orders play out. As in a contrast to that normal trend, last year was some big ticket wins both in India in terms of power sector. We won some large orders in the power sector. We also won some defense orders last year, and we won a large international job in Kuwait. All of this were not repetitive in nature, and consequently the order inflow in the current year are devoid of such large wins. The second aspect to the order inflow is, I think it is a fact that the investment momentum in the economy, despite a lot of efforts that various stakeholders are putting in, is yet to really pick up. There is excess capacity in most of the sectors, and the private sector are more worried at this point in time about better capacity utilization and profitable utilization of existing capacities than spending their time and energy in trying to add to capacity. So the entire demand momentum has to go up in the system for their capacity to be better utilized, for them to talk about new project orders, and then L&T gets into business. So there is a cycle which has a lead lag, and we are still at the lag end of the cycle. Secondly, thanks to the oil prices staying low, the Middle Eastern projects have got into review mode. It's very important for all of us to appreciate that they've not been as much shelved as they've been taken up for review. Because while it is true that the oil prices are low and hence the economics at the output level is very different as compared to the time that they originally conceived when oil was $100 to a barrel, it is also true that times such as these is the right time to add capacities. So it is a balance between cost of lower capacity and the lower economics at the output end. And we find many of these projects are getting reshaped rather than completely abandoned. But this process would take some time, and hence it would take a little while for companies like us who are engaged with them to revisit the bids and the tenders and start bidding and winning for jobs. So we do think it's a phase that we are passing through, and the company would be able to, as both domestic economy and Middle East gets used to better conditions, we could see a little more robustness in the order inflow. The order book has reached 2,44,000 crores, very significant and pretty large, easily covering the next 8 to 12 quarters of revenue of the company. The domestic slowdown in orders during the current year is perceptible. Consequently, the share of international orders are up 35% in the half year as compared to the previous year, which was about 30%. The order book as well as moved up at 28% of the total order book that we have to be executed on international jobs and 72% on the domestic jobs. Where did the orders come from? Bulk of it came from the infrastructure segment, and that's where the spends are happening today. And much of the spends are also happening courtesy the government trying to push some of the sectors like transportation, power transmission, distribution, and water. The benefit of these spends are reflected in 52% of the orders that the company has won, being in infrastructure sector. The rest of the sectors are really scattered in terms of order inflows. Much of the ordering that has been happening, barring power, where 35,000 crores worth of orders have been tendered out, and it's another matter that we have not been successful in those orders. And it is also another matter that we really do not mind not being successful at the prices at which these orders are being won. But barring power, all the rest of the sectors are investing more in terms of capacity augmentation or maybe beneficiation or productivity enhancements. The investments are of that nature rather than brownfield or greenfield expansion. For sake of completeness, all the revenues that we earn in services business are reflected back as orders, because unless the orders are placed on us, we don't deliver the services. So they account for 19% of the order pie that we've had for the year so far. The order book, following the flow of orders from infrastructure sector, 1,75,000 crores out of 2,44,000 crores are from infrastructure sector, and followed by 23,000 crores worth of orders from power sector, 11,000 from metals, minerals, material handling, and 14,000 from hydrocarbon. The rest of them are reasonably small to merit a separate discussion at this point in time. The performance of the group, the company has earned revenue from its operations at a net level of 233 billion rupees for Q2, which is an 11% increase over the previous year. Of the 233 billion, 76 billion rupees came in from international revenues, which accounts for 33% of the revenue. It's also interesting to note that the growth of international revenues is 19%, whereas the overall revenue growth is 11%, which means that the execution challenges that remain in the domestic projects continue through one more quarter. All the operating costs, the manufacturing, the construction, the staff cost, the selling administration, and the cost of doing the entire operations add up to about 208 billion rupees for the Q2, which is a 10% increase over the 188 billion of Q2 of the previous year. The increase in cost is much lower than the increase in sales, which does benefit the EBITDA to stay, to maintain stability. Insofar as the half year is concerned, the net revenues earned by the company at 436 billion rupees is up 9%. The sales from international jobs continue to be similar to the Q2 position at 33% of the overall sales. And for the half year, the international sales have grown by 27%. All of the cost of operations add up to 387 billion rupees, which is a 10% increase over the corresponding period of the previous year. The EBITDA for the company for Q2 has been at 25.92 billion rupees, which is 11% growth over the 23.34 billion of the previous year. For the half year level, it is flattish at 48.82 billion rupees, which is very similar to 48.41 billion rupees of the previous year. The previous year, the H1 of FY15 had the gain from divestment of Damra. So consequently, we had the benefit of EBITDA margins of the previous year enjoying the gain, and hence it is at 12.1% as compared to the 11.2% of the current year. Now, the decline in 90 basis points is largely explained by this single transaction, whereas the margin at the quarter level is pretty stable. The interest expenses for the quarter has gone up sharply, largely because we commissioned 3 road projects in one of the subsidiary companies of the company, which is into toll road business. And when you commission projects in a group, the interest expenses, which hitherto was capitalized for the project, comes onto the financial statement. So much of the increase is this, and because it was a quarter where the adjustment is seen, you find a certain sharp increase, but this will pan out over a longer period of time to more normal. The interest rate that the company at the group level is incurring is at about 9.5%, which in today's time and for the sector that we are participating in is pretty competitive. The depreciation increase is also similarly because of the capitalization of these 3 road projects, and hence apart from the increase in the depreciation because of the Companies Act, the other portion which leads to this increase is this capitalization. Other income has been fairly stable at 2.19 billion rupees, largely reflecting the interest earnings and the dividend earnings of the company. For the profit after tax for the quarter 2, at 9.96 billion rupees, we are up by 16%, and for the half year, we are at 16.02 billion rupees, which is down by 12%. Again, the same reasons of extraordinary income that we had in the previous year. We, as you know, are divided into 10 segments, and namely infrastructure, power, metallurgical, material handling, heavy engineering, electrical automation, hydrocarbon, the developmental projects, information technology, technology services, financial services, and the rest. Now we look at a summary of performance of each of these segments now. Starting with the infrastructure sector, the segment revenue for quarter 2 has been at 106 billion rupees, which is 11% higher than the quarter 2 of the previous year. And for the half year at 189 billion rupees is up by 13%. The EBITDA margins of this sector for quarter 2 at 8.5% reflects a 1.5% decline to the previous year's quarter 2. And for the half year at 9.5% represents a decline of 60 basis points. The decline is largely on account of the status of the jobs and the mix of the jobs. As compared to the H1 or Q2 of the previous year, the percentage of jobs which are waiting to be valued for their margins are larger in this quarter and this half year. Consequently, we have to wait for the jobs to reach their margin recognition threshold before the margins are released in the statement. So it's a point in time situation, and is not reflective of the trend that we see for infrastructure segment as going forward. Insofar as hydrocarbon segment is concerned, the segment revenue is up 7% for the quarter at 19.33 billion rupees, and for the half year it's up 23% at 41.23 billion rupees. As we are executing the jobs that we are having on hand, we are able to see the momentum increase on the revenue side. But what is very important is we need to keep winning jobs to be able to sustain the growth in revenue. So future growth of revenue past the current order book would be reflected and determined more by the order wins that we do. The good news, however, is clients in India are looking at investment in augmenting the energy resources, and the low oil prices have also encouraged the mid and downstream people to look at better opportunities to maximize on the refining margins that they currently enjoy. So I think going forward, it does look, once we are out of the difficulty of the challenged projects that we are executing in the Middle East, and we are almost at the completion, the last leg of those, the way ahead looks promising. Looking at power segment, I did mention at the beginning, there have been orders. I think both the public sector units as well as the state utilities, power generation companies have been busy putting out tenders. There's fair bit of competitive intensity because these orders are available to the market after a while, and hence the price points at which these orders are being won is extremely challenging to the cost structure. Having said that, it is good to be in a position to be able to participate in bids rather than worry about a lack of any investment activity. We do believe that over time we should be able to take advantage of this changing momentum in the power sector. The revenues are up by 21% for the Q2, largely because of progress on execution on the jobs that we are currently engaged with. And for the half year, they are up by 17% at 25 billion rupees. The EBITDA margins are up by 3.1% for the Q2 at 16.1% and down by 3% at 13.3% for the half year. This classically reflects the volatility in the project business and how misleading it could be if people were to draw linear conclusions out of the margins flow.